52% returns in 1 year sounds crazy, right? But I'm about to show you exactly how to achieve it with 3 proven strategies: the wheel, credit spreads, and the poor man's covered call. Even if you think you know these strategies inside and out, stick around because I guarantee you'll pick up something new. So let's dive in and break these down step by step so you can start using them to grow your portfolio today. Let's kick things off with the wheel strategy. I'll explain it in 3 ways: the easy way, the cheap way, and the advanced way. But before we get into those, let's cover the basics for anyone new to this strategy. The wheel works like this. You start by selling put options as a way to get into the stock that you're interested in. By selling puts, you collect premium up front, creating an immediate income stream. You keep doing this until you're eventually assigned, meaning you're obligated to buy the stock. Now that you own the shares, the second phase begins, selling covered calls. This will let you collect even more premium while holding the stock. Eventually, you will get exercised and sell your shares at the agreed upon price. But here's the beauty of it. You just rinse and repeat. Once the stock is sold, you go right back to selling puts. That was just a quick overview of the wheel strategy. If you're looking for a more in-depth breakdown, check out the linked video up top or in the description. Now let's talk about the easy way to run the wheel. This approach sticks closely to the textbook strategy, and here's how it works. You'll target selling put options that give a 1% return on your collateral each week. Why 1%? Because if you repeat this 52 times, you're already hitting your 52% annual return goal. But to make this happen, look for options with a delta around 0.25 to 0.3. These strikes typically give you a 70% chance of your options expiring worthless, meaning you get to keep the premium and don't have to buy the stock. It's simple, effective, and lets you stack up consistent returns. Now, finding that 1% is easier than you think. Just look for a strike price with a premium matching your 1% target. For example, here, a 134 strike on NVIDIA fits that criteria perfectly because the premium pays 134. So just keep targeting that 1% and sell puts indefinitely, adjusting each week to the new strike that fits the requirement. Once you eventually get assigned, you apply the same principle on the call side. Just one key rule here: always sell calls above your cost basis. If you don't, you risk erasing some of your hard-earned progress. Now that's the easy way. Simple, effective, and maybe all you need. But there's a catch. While it's straightforward, it's also expensive. Most of the high-quality stocks you want to run this strategy on are pricey, meaning you'll need to commit a significant amount of capital. Let's use NVIDIA as an example. It's a great stock for the wheel, but you need $13,000 to $14,000 up front to sell fully covered options. That's a lot for many investors, but don't worry. There is a way to lower that collateral amount and still run a version of the strategy. And here's how. We add a tail. Now, I want to be clear. This is a temporary collateral adjustment. This approach assumes you have the full collateral available, but for whatever reason, you might want to hold off on committing the entire amount to the contract immediately. Maybe you're waiting for a better opportunity, or you want to just manage your cash flow strategically. If you don't have the full collateral, no problem. I'll cover a solution for that when we dive into the credit spreads. But going back to adding a tail, this technique lets you borrow some of the premium you receive from selling the put to significantly reduce your collateral cost. Here's how it works. Let's say that we only have $4,000 available as collateral right now. I can effectively borrow $10,000 by purchasing a tail. So to demo this, we go back to the option chain and switch to the buy and put tabs. And we want to scroll to a deep out of the money put option. So if we go all the way down to, say, the 100 strike put, we can see that this put option only costs $3. But if I add this to the option order, you can see that it actually reduces the collateral required to $4,000 instead of $13,400. And once you're ready to commit, you can simply sell to close the long put and add in the remaining collateral. This approach works best for longer expiration contracts since it gives you more flexibility to manage your cash flow. Just keep in mind that this strategy is only used on the put side. Now let's dive into the advanced way to run the wheel. The advanced way is a bit wild, but stick with me. You can actually infuse these covered options with a debit spread in order to supercharge your max profit. Let me show you how. Let's go back to the option chain and remove this long put that we added. We want to scroll back up, and we actually want to be buying a put option that's close to being in the money. So in this case, that would be the 136 put. Then we can go into our order form and edit the ratio to actually sell 2 puts at the short strike. Now you'll see when we go back to the order form, our P&L chart has changed significantly. What's actually happening here is we adjusted the cash secure put strategy to actually give us a higher profit if we were to get assigned. I'm calling this an advanced strategy because you want to use these only when it makes sense, as adding in this spread does lower your upfront premium, but you can almost double your max profit, so it's definitely worth noting. And you can apply this on the call side as well. This adjustment, when done properly, can drastically get you to that 52% return quicker. Now, on the credit spreads, these are great in and out strategies, and they require way less collateral. But you win or you lose, there's not really an in between. Let's use the SPY for an example, because this is probably one of the best tickers to run this strategy on. And that's because there's an expiration date almost every single day, allowing you to do 3 or more trades a week. If you aren't familiar with the strategy, I'll link a video up top. Plus, I have a ton of content specifically on credit spreads because it's just such a good strategy for smaller accounts. So let's move forward and demo the easy way. Go a few days out. I like to do every other day, so I'll select the December 31st, and we're just going to want to be selling around the 0.3 to 0.25 delta and then buying 5 strikes lower to cover the short put. If you don't see the delta here, you can actually manage what's displayed on the option chain at the top right. For option selling, I like to look at delta and also volume, but you can configure this to what you like to see. Back to the option chain, we can see that the 590 strike put is right at that 0.25 level. So I'll select that one and then I'll scroll down 5 strikes and buy the 585. Pulling this up, we can see that we receive $75 up front on $500 as collateral. That is a 15% return in 2 days. That's wild, and you can be doing 3 of these a week. Now, you can make this trade even cheaper by lowering the strike width. So instead of buying a strike 5 strikes lower, we can actually buy one that's just 1 strike lower and see that we can get a $20 credit up front with a collateral of $100, which is a 20% return in just 2 days. These spreads have defined risk and profit, which makes them very versatile. Now, for the advanced one, I don't necessarily recommend this, but if you do proper technical analysis and you feel very confident on the direction of the underlying stock, you can actually sell an at-the-money credit put spread, which will practically give you a 50% return on collateral. Now onto the last strategy, the poor man's covered call. This is a great strategy for a bull market and can easily give you amazing returns. I'll link a full video to this specific strategy up top, so check that out if you want a deep dive. But for the easy way, let's jump over to the option chain. You're going to want to start by going out at least 9 months. So I'll select September here, and we want to be buying a call that's around a 0.8 delta at least. Having at least a 0.8 delta is very important, and I'll show you why in a second. So let's select the 160 call here. It's about a 0.82 delta and a volume higher than the strikes above and below it, which is perfect. Now that we have that selected, we can go to just about a week out and look for a covered call to sell. The sweet spot here for the short call would be a strike that has a delta of 0.2 or less, or else we'll risk taking a loss if the stock just skyrockets to our short strike. So for now, let's sell the 197.5 strike call. Looking at the P&L chart, we can see that this trade has practically no downside on the upside. Technically, it is possible to see a loss here, but Google would have to go all the way up to $264.54 in just 1 week, which is very unlikely. Now, how do we use this strategy to get a 52% return? Well, the short strikes that we're going to continue to sell against the leap is roughly going to be providing a 1.7% return per week, which would get us to our goal in 30 weeks. However, we can get an even higher return when we factor in profits from the leap. So if we actually hit our short strike, we could close the whole position for $445, which is a 10% return on collateral. Then just restart the poor man's cover call strategy again with a new leap. So whether you're running the wheel, credit spreads, or the poor man's cover call, these strategies prove that 52% returns are achievable with consistent execution and the right mindset. And that's my options trading blueprint for achieving a 52% return in 2025. If you've enjoyed this video or learned something new, please consider subscribing and dropping a comment. I'd love to hear your thoughts. Thanks for watching and happy trading.